For small business owners, the thought of just handing out a load of money to the government doesn't feel too pleasant. Trust me, I know. That's why small business owners just like you should love tax deductions. My name is Sierra Stanberry, and I help small businesses make smarter decisions today to build lasting wealth tomorrow. Do you want to keep money in your business, or do you want to give your hard-earned money to the IRS? I think we all know the answer to this question, and in this video, I'll give you 5 ways that you may be able to keep money in your business. I will discuss exactly what tax deductions are, the 5 most missed tax deductions that I've seen with my clients who are small business owners, and provide comprehensible examples along the way. Please don't forget to like, comment, and subscribe so I'll know this video was helpful and you won't miss out on the next videos to come. Let's jump right in. So what are tax deductions and how do they work? Tax deductions are expenses that decrease your gross revenue in order to give you your taxable income. The lower your taxable income, the lower your tax liability. This allows you to put more money back into your business instead of the IRS pockets. Let's say you made $100,000 gross revenue for the current tax year. It doesn't mean that this entire amount is going to be subject to taxes unless you have no tax deductions. If you have tax deductions, aka deductible expenses, totaling $20,000, you would only be taxed on $80,000 instead of the $100,000 mentioned earlier. This is why you should be aiming to get as many tax deductions as possible. Per the IRS, in order to have a deductible expense, the expense must be ordinary and necessary. Ordinary meaning something that is normal in your operating business. Necessary meaning something that is useful to your business. For example, if you run a delivery business, maintenance and fuel will be ordinary and necessary to run your business. Therefore, you would be able to deduct 100% of the maintenance and fuel for your vehicle as long as the vehicle business use is 100%. Please keep in mind when looking for deductions, make sure they are meaningful deductions. Deductions don't decrease your tax liability dollar for dollar. They only decrease your taxable income dollar for dollar. Let me repeat that. Deductions don't decrease your tax liability dollar for dollar. They only decrease your taxable income dollar for dollar. Please don't go out and buy things just to get a tax deduction unless it's truly needed and you are going to use it. Your costs will far outweigh your benefit every time you do this. Now we know what tax deductions are and how they work. Let's talk about the 5 most missed tax deductions. These are in no particular order. Tax deduction number 1, home office deduction. So many of my clients missed out on this deduction in their previous tax year only because they didn't know they qualified. Some of my clients who rent an apartment thought the deduction was only for individuals who owned a home, and that's just not true. This deduction can be used whether you rent or own. If you live on a boat, that can be considered a home. Yes, a boat. As long as it's your home and you're a small business owner, you may qualify for this deduction. To qualify for this deduction, you must have space that is regularly and exclusively used within your home for business. You can't use this space for personal and business purposes. If you do, it's no longer considered deductible. For instance, if your parents come to visit and you convert your business space into a bedroom with a Murphy bed, or if you're doubling down on your kitchen island as a workspace and kitchen space, it's no longer deductible. Now there are 2 ways you can calculate the home office deduction. You can use either the simplified option or the regular method. The simplified option doesn't require you to have a detailed record of your expenses. You will only account for the actual home office square footage in your home. You can deduct up to 300 square feet at $5 per square foot, which means you can deduct up to $1,500 for your office space in your home. For example, you measure your office space at 200 square feet. You would multiply that by $5 to get your total deduction of $1,000. This method is usually used by business owners who don't have a lot of business expenses or who have kept track of their expenses. Under the irregular method, you would account for actual expenses of maintaining your home, such as utilities, repairs, mortgage interest, real estate taxes, etc. This method does require you to keep up with your home expenses. In order to calculate the deductible amount under this method, you would take the square footage of your office space and divide that by the total square footage of your home, which gives you the business use percentage of your home. You would then multiply the business use percentage by the total home expenses to get the amount of the deduction. For example, let's say your office space is 200 square feet. The total square footage of your home is 1,500 square feet. You would divide 200 by the 1,500 and get 13% business use. Let's say you have annual home expenses of $1,200 for your utilities, $1,000 for cleaning service, $600 for internet, $4,000 worth of home depreciation, and $600 for security system, totaling $7,400. You would then take that total amount of expenses, said $7,400, and multiply that by the 13% business use calculated earlier. Your home office deduction will be $962. This total doesn't even include mortgage interest, real estate tax, repairs, etc., and you're already at $962. Which method is best? Most of the time, you would choose the method that gives you the highest deduction, with an exception that will be mentioned at the end of this video. All right, I know that was a lot. Feel free to rewind to catch everything you missed. Up next, most missed tax deduction number 2. Business travel. To qualify for business travel deductions, your trip has to be primarily for business. No one said the full trip has to be for business, just mostly for business. You can't just hop on a plane to Cali, say it's for business, and deduct the full amount. Well, what can you do to get qualified for business travel? Glad you asked. Here's how to make sure your travel qualifies as a deduction. Ask yourself these 4 questions. Question number 1. Was my trip mostly for business? Meaning if your trip is 7 days long and you spend 4 days doing business and 3 days vacationing, the trip is considered a business trip. Now, if your trip is 7 days long and you spend 3 days doing business and 4 days vacationing, it is not considered a business trip. Have more business days and vacation days on your trip and you're good to go. Listen, y'all, like I said before, you can't just show up to Cali, go to the mall, socialize about your business, maybe even give out business cards at a theme park and expect to be able to call that a business trip. Question number 2, did I leave the city that my business is based in longer than a normal workday and with intentions of doing business where I am traveling to? Let's say your business operates in Georgia and you're traveling to Cali for some days. It's considered business travel as long as you are gone more than a normal workday and you have the intent to do business, such as attending a conference geared towards your industry. Question number 3 to ask yourself to see if you qualify for business travel is my trip an ordinary and necessary expense? Here's that ordinary and necessary phrase again I mentioned earlier in the video. Please feel free to rewind to the beginning of this video if you missed out on what this phrase means. Question number 4, did I plan the trip in advance? The business trip has to be planned, meaning you will need to plan your day out to the T before you take this trip. Write down where you will be each day, the dates, and who you will be with. It will behoove you to write this in an email and send to yourself just to have a timestamp of when it was planned, just in case the IRS wants to be Mr. Officer. It helps to show the IRS your business intent. If yes is the answer to all 4 of these questions, your travel more than likely qualifies for business travel. Some of the expenses you may be able to deduct as business travel are airfare, hotel, transportation, dry cleaning, meals, etc. The third most commonly missed tax deductions is startup and organizational costs. If you have just started your business, this one's for you. Startup costs are amounts paid or incurred to start your profitable business, which can include but are not limited to the money you spent doing market research, advertising your business lunch, and professional fees. Organizational costs are costs incurred while organizing your business, which can include but is not limited to incorporation fees, legal fees, etc. Now, business owners often miss these deductions because they start the accounting from the day the bank account is started, which is often when the business is starting to make more money or is becoming more profitable. How much can you deduct for startup and organizational costs? You can deduct immediately max of $5,000 $50,000 with the first year of launching your business and amortizing the remaining amount over 15 years only if your startup cost totals $50,000 or less. The deductible amount for the launch year goes down as you spend more than $50,000 on startup and organizational costs. Let's say you spent $50,000 or less in your first year on startup or organizational costs. You can deduct the full $5,000 of those costs immediately in the year that your business launches and amortize the remaining $45,000 over the following 15 years. What happens if you spend more than $50,000 in your first year? Unfortunately, the deduction decreases. For any amount over $50,000, the $5,000 deduction decreases dollar by dollar for any excess amount over the $50,000 cost. For instance, let's say you spent $53,000. Your allowable deduction amount for your launch year goes down to $2,000, and you amortize the remaining $51,000 over 15 years. If you spent more than $55,000, you can't deduct any costs within the first year. You have to amortize the cost instead. Got it? Good. Let's go to the most missed tax deduction number 4. Business use of vehicles. If you use your vehicle for business use, you may qualify for this deduction. If you use your vehicle for strictly business purposes, you can deduct 100% of costs for operating that vehicle. Well, what if you use it for business and personal? You can only deduct the business usage percentage of the cost. You can get the business usage percentage by taking the business miles driven and dividing that by the total miles driven for the year. Now, there are 2 methods that you can use to deduct vehicle expenses. The first method is called the standard mileage rate, and the second method is the actual expense method. Under the standard mileage rate method, you would take the number of business miles driven and multiply it by the mileage rate given by the IRS. 2023 tax year, the mileage rate has increased to 65 cents per mile due to higher gas prices, etc. Let's say you traveled 10,000 miles annually as a real estate agent to show clients potential homes. Yes, 10,000 miles is possible in Atlanta. You would take the 10,000 miles and multiply the tax year's mileage rate, in this case, 65 cents per mile, which equates to a deductible amount of $6,550. I know you are probably thinking, who's about to track all of that? Listen, I'm just a messenger, and if you want to give the IRS your hard-earned money, have at it. Listen guys, there are apps out there to track your mileage for you, such as QuickBooks Online, MileIQ, etc. You just have to find the right one to fit your needs. Work smarter, not harder. Under the actual expense method, you would take your operating expenses for your vehicle, such as repairs, tires, insurance, registration fees, lease payments or depreciation, etc. Then multiply the total operating vehicle expenses by the business use percentage of miles driven. Business use percentage is calculated by totaling the amount of business miles driven divided by the total miles driven for the year. For instance, let's say you have $300 worth of repairs, $400 for purchased tires, $1,800 for fuel, and $4,000 vehicle depreciation, which totals $6,500. If you use this for 100% business use, you can deduct the full amount. If you use the vehicle for 70% business use, you can deduct $4,550. Now, both methods require you to track something. Which method is better? Well, it all depends on which one will give you the highest deduction. You would be surprised how much of a deduction you could get if you would just track your mileage and actual expenses, especially if you use the vehicle 90% of the time for business. We're down to the finale, guys. Most missed tax deduction number 5. What if I told you that you can rent out your primary residence tax-free? Well, you can. This is called the Augusta rule. How can I qualify for this deduction? Glad you asked. There are certain requirements that must be met in order to take the Augusta rule. Requirement number 1, the number of days the property is rented has to be 14 days or less. They do not have to be back-to-back days. These rental days can be spread out all throughout the year. Just make sure you don't go over 14 days because it will disqualify you from this deduction. Requirement number 2, the rent amount must be a reasonable amount. Figure the rental rate out by doing market research. You can go on websites like Airbnb and search for similar properties in the same area as your home, and voila, there's your rental rate. Requirement number 3, you must be an S corporation, C corporation, or a partnership in order to take this deduction. If you are an LLC, you must be taxed as one of those 3 that I just mentioned. Requirement number 4, you must have a true business purpose for renting out your home, such as a business meeting, a mastermind, etc. Requirement number 5, you must have a written rental agreement with your business. So up until this point, we went over what tax deductions are, the most missed tax deductions based off of what I see with my clients, which were home office deduction, business travel, startup and organizational costs, business use of vehicle, and last but not least, the Augusta rule. So let's wrap this up with what most tax preparers either forget about or just don't inform you of when taking these tax deductions. I was totally shocked when some of my clients told me what their tax preparer didn't inform them of. The home office deduction can only be taken to the extent of your gross income. Meaning, if you have $0 of gross income, you can't take this deduction on your current year's tax return. However, you may be able to carry the unused portion forward to the next tax year. Also, there are costs that can be deducted 100% instead of the business use of your home percentage. These costs are anything strictly related to your office, such as a desk, office chair, picture frames, etc. You may hear a tax preparer refer to these as direct costs. Business travel can be maximized for your benefit. Your travel days automatically count as business travel, as well as weekend and holidays if they fall between the days you are traveling for business, and makes it impossible to travel back home. Oh, let's not forget, if you're on standby for work, or if you intended to work but couldn't due to unforeseen circumstances out of your control, those days still count as business travel days also while traveling. In regards to the business use of your vehicle, the first year your vehicle is used for business, you have to use the standard mileage rate method in order to have the choice between that method and the actual method in future years. Choose wisely. Another thing tax preparers fail or forget to mention is when using the Augusta rule, your property must be in the US. You can't rent out your vacation home in another country and take this deduction. Also, if you use the Augusta rule, you can't use a home office deduction. Although I've provided explanation on these tax deductions, please consult with your tax professional to make sure your situation allows for you to take these deductions. Well, that's it. I'm Sierra Sanberry, and I'll see you in the next video. Take care.